What the hell are stock options as part of salary and how do they work? Part 2. When your company gives you stock options, they are giving you the option to buy your company's stock at a specific price. But you don't just have to worry about putting up your own hard-earned money to buy those shares. You also have to worry about disqualifying dispositions and AMT. A disqualifying disposition happens when you buy the shares using your stock options and then you sell them either before 2 years after the grant of those shares or 1 year after you exercise those shares. So in order, your company gives you the option to buy shares, that is your grant. Then you buy the shares, meaning you exercised them, and then you sell the shares. So in order to sell the shares and have a qualifying disposition, you have to wait for 2 years after they were granted and 1 year after you bought the shares. Now, let's say you exercised the shares at $15, but the stock price at that time was worth $30. The difference between these two numbers is called the bargain element. If you have a disqualifying disposition, that bargain element, that difference, is going to be taxed as income, whereas normally it would be completely tax-free and you would only have to worry about paying taxes on gains beyond $30. Well, they should be tax-free, but they can sometimes get into the alternative minimum tax or AMT range, so that's a topic for part 3.